Yes.
This is the question on group accounts. Depending on your this may take us time to finish as well, but that time, unfortunately, is not available to be able to do this. This is called an necessary question. That is a necessary question. So what I'm thinking of doing is see how far I can go with the other standards that we have here on this, that we have questions here. See how far we can go on them. IFRS 32, IFRS 9, IFRS 8, IS 8, IFRS 10. And it's briefly to talk about what the standards say and now go ahead and solve the question. So that is what I'm thinking. If we all agree to do that, then I can jump the group account. I'm assuming everyone will have dealt with group accounts extensively. I think for the people in the class, they've done that. For the Ivy League students, they've done that group extensively. If you're unable to touch that question, I can solve it and send you the solution. That is the question 4. Sorry, the question on group account, I can send it to you. It means we won't solve it together. So let me quickly run through IS 32. Luckily, we've done a bit of what IS 32 is all about. We've done a bit of it today. And how? When we came across that compound financial instrument in that question, so I was forced to talk about briefly what IS 32 is all about. IS 32 it starts by defining what is a financial instrument. It defines financial assets. A financial asset doesn't have a straightforward definition. It says financial assets include cash, the cash you have in your hand, the cash you keep in the office, the cash the banks keep in the vault. They are all financial assets. And in the definition of financial instrument, it shows that whatever you say as a financial asset will be in the books of two different entities simultaneously. In the book of one of the entities, it will be there as a financial asset. In the books of the second entity, it will be there either as a financial asset or as a financial liability or an equity instrument. Then, financial asset is also defined to include equity instrument of another entity, meaning that when you invest in the equity instrument of another entity, it is a financial asset in the books of the investor. Then the other part of the definition says contractual right to receive cash or another financial asset from another entity. So when you have trade receivable, you have the right to receive cash. Trade receivable is a financial asset. When you have loan receivable, it's a financial asset. You have investment in bond or treasury bills, it's a financial asset because you've got the right to receive cash. You invest in preference share, it's a financial asset because you have the right to receive cash. You put money in the bank, it's a financial asset because you have the right to receive cash. So many financial assets will fall in that category. Financial liability is defined to include contractual obligation to pay cash or give another financial asset to another entity. A good example of that is you've borrowed money from the bank, you have the obligation to pay the money back and pay interest. So financial liability includes borrowing. It includes loan payable. It includes loan payable. If your customer, I have a question for you guys. If you are selling goods and your customer has paid you in advance, the customer has deposited money in advance for the goods that you will supply at a later date. The supplier pays you money for the goods you will supply at a later date. Is that a financial liability within the scope of IFRS IS 32? What do you think?
No.
No, it's not, but it's a liability.
It's a deferred liability.
It's a liability. What name do we call that type of liability? We call it contract liability under IFRS 15, contract liability. That is it. Tax payable is not a financial liability. You know why? Yes, you have the obligation to pay tax to the tax authority, but it does not arise from any contract that you have with government. That is why tax payable is not a financial liability. The definition of financial instrument starts from a contract. So any liability that arises not from a contract you have, there is not a financial liability within the scope of IS 32 and IFRS 9. Then after that, I'm sure you learned how to determine whether the instrument you have issued is a financial liability or an equity instrument. If you issue an instrument and you have the obligation to pay cash, or transfer another financial asset to another entity, then it is a financial liability. When you do not have such obligation, then it is an equity instrument. Ordinary share is an equity instrument, not because we call it ordinary share, but because the company that issues the share does not have obligation to pay cash to the holders of the ordinary shares. The company that issues does not have obligation to pay cash to the holders of the ordinary shares. Dividend. It is only when the company has declared the dividend that it will pay. You've seen companies that never pays dividend for years. The shareholders cannot take that company to court because the company doesn't have the obligation to pay dividend on ordinary share. You must have been told that a preference share that is redeemable, mandatorily redeemable, is a financial liability. A preference share that is redeemable at the option of the holder is a financial liability. You must have been told that an irredeemable preference share is an equity instrument, or a preference share that is redeemable at the option of the issuer is an equity instrument. Compound financial instrument, you did it today, so I don't really want to revise that again because everything I will have said, we have done it today. The convertible loan note we saw in that question is a good example of compound financial instrument. And the only thing you learn again is when you issue equity, the issue cost should be charged to equity. So that is the only thing I need to mention. And that marks the end of IS 32. If you move to IFRS 9, IFRS 9 deals with financial assets. It deals with financial liability. It does not deal with equity instrument in the books of the issuer. I will say that again. IFRS 9 does not deal with equity instrument in the books of the issuer. It only deals with equity instrument in the books of the holder. Who is the holder? The one we invested in it. The one we invested in that equity instrument, we carry it as what? As a financial asset. The one we invested in that equity instrument, we carry it as a financial asset. So IFRS 9 deals with financial assets and financial liability. IFRS 9, they must have started by telling you that initially you measure you should recognize recognition criteria. You should recognize financial asset or financial liability in your books once you become a party to the contractual provision of the instrument. Once you become a party to the contractual provision of the instrument, then you should recognize it as an asset in your book. Aside from that, they talked to you about initial measurements, and they must have told you that initially, how you measure a financial asset depends on how it will be measured subsequently. How you measure a financial asset initially will depend on how it will be measured subsequently. For financial assets that will be subsequently measured, at fair value through P&L, the initial value should be fair value. The initial value should be what? Fair value. Transaction cost should be what? Should be expensed. Transaction cost should be expensed. Transaction cost should be expensed. For financial assets that will not be subsequently measured at fair value through P&L, i.e., those that will be subsequently measured at amortized cost, and those that will be subsequently measured at fair value through OCI, the initial measurement or initial value should be fair value plus transaction cost. That means this transaction cost there should not be expensed. The transaction cost there should not be expensed. Now, what about financial liability? Initial measurement of a financial liability that will be subsequently measured at fair value through P&L. The initial value should be fair value. Transaction cost there should equally be expensed. But for any financial liability that will not be subsequently measured at fair value through P&L, that is, those to be measured subsequently at amortized cost, the initial value should be fair value less transaction cost. Fair value minus transaction cost. That should be the initial value. Okay. We talk about subsequent measurement for financial assets. Subsequent measurement for financial assets. They must have told you that how you measure financial assets subsequently depends on whether it's a debt instrument, whether it's a derivative financial asset, or it's an equity instrument. However, at this level, you are not dealing with derivative financial asset. So I take that away. Excuse me. So if you now look at equity instrument, investment in equity, typically ordinary shares, in the books of the investor, there are two tests they say you should conduct. The first one is called SPPI test, which is contractual cash flow characteristics test. SPPI means solely payment of principal and interest. If you look at investment in ordinary share, it will not pass that test, because when you invest in ordinary share, the cash flow you get is not in form of interest and principal. It's in form of dividend and proceed from disposal. So investment in ordinary share that is held for trading will be subsequently measured at fair value through P&L. But investment in equity instrument that is not held for trading, you need to make an irrevocable decision as to whether you want to measure it at fair value through OCI. If you opt for that, you will subsequently measure that fair value. Changes in fair value will go to where? OCI. But if you don't opt for that, you will subsequently measure that fair value, and fair value changes will go to where? P&L. So in other words, when it comes to investment in equity, It's either it's fair value through P/L or it's fair value through OCI. When we say it's fair value through P/L or OCI, it means if you buy a financial asset for $100 at the beginning of the year or during the year, $100. At the end of the year, you look at what is the fair value in the market. If the fair value in the market is 120, it means what you should have in your SFP should be 120, being the fair value at the end of the year. It should be that 120. You will now compare that 120 with the value at the day you bought it, which was 100. That means you have had a fair value increase of how much? Of 20. That 20 will go to P/L if the equity instrument is fair value through P/L. Or it will go to OCI if that equity instrument is fair value through what? OCI. But in any case, that investment will be sitting in your SFP at 120, being the fair value at the end of the year. But the fair value gain of 20, we either go to P/L if it's fair value through P/L as a gain as an income, or it will go to OCI if it is fair value through OCI. And from that OCI, it will go to a separate reserve, non-retained earning. It will go to a separate reserve. It could be a loss. The illustration I've just given to you is a gain, but it could also be a loss. For the debt instruments such as trade receivable, loan receivable, investment in bond and treasury bills, in most cases, there are three business. If it passes the SPPI test, the second test is business model test, and there are three business models. The first one is hold to collect the contractual cash flow. If you are holding the financial asset to collect the contractual cash flow, you measure it at amortized cost. But if you are holding it to collect the contractual cash flow and to sell as well, then that one you measure it at fair value through OCI. But if you are holding it strictly to sell, which is the third business model, you measure it at fair value through P/L. At your level, the examiner is likely to focus more on debt instrument measured at amortized cost. Amortized cost is a very interesting topic because it could apply to financial assets, it could apply to financial liability. So when it comes to subsequent measurement of financial liability, although there are some financial liabilities that can be measured at fair value through P/L, but at your level, you are not expected to know that. At your level, financial liabilities are mainly measured at amortized costs. What is this amortized cost? If you guys remember the question we solved today, that convertible loan note, working 1A in that question was split accounting. Then working 1B, I said subsequent measurement of the 6% loan note at amortized costs using effective interest method. We said opening balance, finance costs, interest paid, then we have closing balance. I told you that closing balance is the amortized cost. That is how you will do it for the second year. That is how you will do it for the third year. And in the third year, you will discover that the amount will go back to that 40 million in that question. We measure financial asset at that amortized cost. And if it were to be a financial asset, it's the same process. You will have opening balance. Instead of finance cost, you will now have interest income. Instead of interest paid, you will now have interest received. Then you will have closing balance. So that is how we measure financial assets at amortized cost as well. Having said that, they must have equally taught you about the recognition, because at your level, financial instrument is wide, but at your level, you are not doing derivative, you are not doing embedded derivative, you are not doing hedge accounting, you are not even doing impairments. So it's only the basic part of it that you are doing here. All those other ones that I say you are not doing, you will do them when you are talking of SBR. So the only thing they must have told you again is the recognition of financial assets and liability. You should recognize financial assets either when the contractual right to the cash flow has expired, or when you have sold or transferred that financial asset to another party and you have transferred the risk and reward of ownership. You have sold or transferred that financial asset to another party and you have transferred or moved the risk and reward of what? Ownership to the other party. So if the risk and reward has been transferred, it should be recognized. Or if the risk and reward has not been transferred, then you cannot recognize. If you look at the application of that concept, there is something we call factoring of receivable. You might have learned it in FM as well. You know, receivable, you can factor. Factoring receivable means there is a third party that is called factor agent. And you have this trade receivable in your book. You cannot wait for 30 days or 60 days to collect the money from the debtor that is owing you. You now approach a factor agent to come and buy the receivable from you. If that trade receivable is sold to that factor agent without recourse means if the factor agent cannot collect the money in full from the debtor, it should not come back to you. It should not return back to you. It's his own loss. That means you have transferred the risk and reward to the factor agent. In that case, you should recognize the trade receivable. That is, remove it from your books, recognize the proceeds that you receive from that factor agent against that trade receivable. The difference between the two represents profit or loss on disposal. Assuming the receivable you factor is 100 million, but you have sold it to the factor agent for 95 million and it's without recourse. It means you will remove the trade receivable of 100 million from your book. You will recognize the proceed of 95 million. The difference of 5 million represents a loss that you should recognize in pure health. However, if you factor it without recourse, with recourse means if you can't collect that money, it should come back to you. If you can't collect any amount, it should come back to you. You will pay whatever you have collected from the factor agent back to the extent of the amount that it cannot collect. In that case, you have not transferred the risk and reward. The risk and reward still remain with you. So if that is the case, what should happen? You cannot recognize the trade receivable. It should continue to be in your book. It should continue to be in your book. Then the 95 million you collected from the factor agent, the accounting entry you will pass for it is you will debit your cash and you will credit liability. You will debit your cash, you will credit liability. It shows that the substance of that arrangement is that of a borrowing. You have borrowed money from the factor agent. That is the substance. You see your trade receivable as what? As a collateral. You see your trade receivable as a collateral. That is the substance of that arrangement. So those are basically what you actually need to deal with. Those are basically what I want to revise. What I want to revise with you. Having said that, unless there are questions, can we go ahead and look at these question that we have in this IAS under this IFRS 9. Can someone read why we solve it together?
Okay. Yes. Okay. I thought you said we should read.
Yeah, read. So I've done that to me. Others should go on mute. It's only you that should not be muted. Others should go on mute. Go ahead and read, please.
Number one, how are financial assets measured under IFRS 9, excluding assets held for trading or subject to a specific designation? A. Fair value. B. Fair value plus transaction cost. C. Fair value minus transaction cost. D. Amortized cost. I choose B. Fair value plus transaction cost.
Okay, when you were reading, you missed something there. How are financial assets initially measured? You omitted that initially. Do you agree?
Oh, yeah.
Do you agree with him that is B? Do you guys agree with him? Anybody with a contrary view? Anybody with a contrary view? So no contrary view, the correct answer is B, like you have said, is B. I've just told you that today is B. Fumi, your hand is up.
Yes, please. So I agree with the solution. I just have a question on the excluding assets held for trading or subject to specific designation. So if they had said including, would they have made a difference in that?
They cannot, if they say including, then they are creating problem. The examiner will not be a good examiner in that case. Because I've told you today that for the purpose of measuring assets initially, there are more or less two categories. For those that will be subsequently measured at fair value through P&L, the initial value should be fair value, transaction cost should be expense. But for those that will not be subsequently measured at fair value through P&L, that is, those to be measured at amortized cost or fair value through OCI subsequently, the initial value should be fair value plus transaction cost. So they need to make it clear here, because the reason those they put in brackets, those are the ones that will be subsequently measured at fair value through P&L. The one they put in bracket, those are the ones that will be subsequently measured at fair value through P&L. So they've excluded those ones. It means what you have left should be financial asset that will be subsequently measured at amortized cost or fair value through OCI. And those ones, initial value should be fair value plus transaction cost.
Thank you.
So examiner should be very clear like this. Number two, read number two.
How are financial liabilities initially measured under IFRS 9, excluding liability held for trading or subject to a specific designation? A. Fair value. B. Fair value plus transaction costs. C. Fair value minus transaction costs. D. Amortized costs. I choose C. Fair value minus transaction costs.
Okay. You choose C. Do you guys agree with him? Do you agree with him?
Yes.
Anybody with contrary view? No. Because I've just said this today, so the correct answer is C. The correct answer is C. Okay, read the third question. Read the third question.
Which of the following is not classified as financial? Sorry, continue.
No. Continue.
Okay. Which of the following is not classified as a financial instrument under IAS 32? A. Share options. B. Intangible. C. Trade receivables. D. Redeemable preference shares. Which of the following is not classified as a financial instrument under IAS 32 financial instrument presentation?
So which one is it?
B. Intangible assets. B.
B.
Okay, the reader did not choose this time around. He left us on our own. Okay, the correct answer is B. The correct answer is B. Yes, the correct answer is B. Okay. If you look at this question 4, right? Due to lack of time, I will not do it for you. I won't do it. You know why I won't do it? Because there is no time. And I'm looking at what the time we have left. And I'm looking at, what is it called? The fact that my colleague will come in. And I'm looking at the fact that I have IS-10 and IS-8. So for that purpose, I won't do this because it has to do with convertible, like the one we saw in the question of today. So what I would rather do is I will give you the solution here, but you must go and figure it out what the correct solution will be, right? You must go and do the calculation to make sure you arrive at this amount. What they're asking here is what amount will be credited to equity on 1st April 2005 in respect of this financial instrument. So what you need to do is you do split accounting, similar to what we did in question 1A today. You will do that split accounting. And when you do that split accounting, please, you must arrive at this figure. I'm sure you will arrive at this figure if you follow the same process. Please do it at your leisure time. Okay, so go on. Read question 5 for us. Read question 5 for us.
Why statement?
Please, you guys take the picture of the solution now. Take the picture because I may not send you the work example today. Take the picture of the take the screenshot of that. So yeah, continue.
WIME draft statement of financial position as at 31st March 2008 shows financial assets at fair value through profit or loss with a carrying amount of $12.5 million as at 1st April 2007. These financial assets are held in a fund whose value changes directly in proportion to a specified market index. At 1st April 2007, the relevant index was 1,200, and at 31st March 2008, it was 1,296. What amount of gain or loss should be recognized at 31st March 2008 in respect of these assets?
Okay. You want to choose as usual? And we'll see whether the masses will follow you. Why are you not choosing now?
To be a king because the interest has increased. So.
You need to choose so that we know whether the masses will follow you now.
I think it's A.
No.
Move up. It's only option A that we can see now.
How did you get A? For me. Did you use your eyes to control this solution? When did you do it? As it was finishing reading?
Yes.
Now, you solved it before today?
No, I solved it today.
Oh, okay. Before we... Well, not now, because if you do it now, I'm wondering how you were able to quickly do that. Do you agree with her that it's A? That is what she said. Yeah. Do you guys want to agree with me that it's A? I don't know. I myself don't know.
I don't know. So please, let's do it too.
We should do it. So, okay. Okay, so I'm sure you guys have taken note of what you have. The answer to question 1. Sorry, call it for me again. I'm saying question 1. MCQ, multiple choice, use on IAS 32 and IFRS 9. I will share my screen now for the Excel so that you can see. Just hold on for some seconds. Sorry, question 1, you remember the answer? The answer that we selected for question 1, we said is what? Is B, right?
B.
It's
Question
B.
1 is
Yes, sir. B.
question 2.
C.
C.
I think we selected C, right?
Yes, sir.
Question 3, we selected what?
B.
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 B, right?
Yes.
Question 4,
B.
we selected what? B.
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 Okay. But I said you should figure out why it is B, right? And you have assured me you can do that. So question 5 now, that is the one we're about to do together. So let me share my screen. You can see the Excel, right? Question 5. Question 5. Question 5.
Oh, we can we can see the question.
You said?
Okay, we can see the Excel now. No, we can see the Excel now.
Okay, okay, okay. Okay. Sorry, okay. So what are we asked to do in B? What amount of gain or loss should be recognized at 31st March 2020 in respect of this asset? Amount of gain or loss to be recognized in where? At 31 March 2008. In respect of, IRO stand for in respect of the assets, right? Okay, so let's go ahead and do the calculation. From what you read, it says, why need draft statement of financial position? As of 31st March 2008 shows financial assets at fair value through P&L with a carrying amount of 12.5 million at 1st April 2007. These financial assets are held in a fund whose value changes directly in proportion to a specified market index. At 1st April 2007, the relevant index was 1002. But at the end of 31st March 2008, the end of the year, it was 1296. What amount of gain or loss? Okay, so the question is very simple. Okay. So let's go ahead and say it. So we say here at 31 March 2008, right? I'm coming back to that. Then we have fair value at the beginning of the year, which is 1 April 2007, right? That one has been given to us already as how much? 12,500, right? That has been given to us as 12,500. So what I want to do here is I want to get the gain, the fair value change. So to get what the fair value will be at the end of the year, very simple. What you are supposed to do is actually for you to say that fair value, the 12.5 at the beginning is based on the index of 1,200. Remember they said it varies based on index. It's based on index of, so I say 12.5 that you have at the beginning. If you divide it by that index of 1,002, which is the index at the beginning, then you multiply by the index at the end of the year, which has increased to 1296. That should give us the fair value at the end of the year. So we say 12,500 divided by what? 12 times 1296, right? That is 13,500. That is 13,500. So at the beginning of the year, it was 12,500, and it has increased to 13,500 at the end of the year. Then you have fair value gain. You have fair value gain. You have fair value gain. So of how much? The difference between 13,500 and 12,500. So that is a fair value gain in pure health. So for me, it's correct. A is the correct answer. That is A for you. A is the correct answer. A is the correct answer. So we've done it for those who requested that we should do it. Can we go to question 6? What is question 6 talking about? Can you read it? Read question 6 for us.
Question 6. A 5% loan note was issued on 1st April 2010 at its face value of 20 million. Direct costs of the issue were $500,000. The loan note will be redeemed on 31st March 2013 at a substantial premium. The effective interest rate is 10% per annum. At what amount will the loan note appear in the statement of financial position as at 31st March 2012?
Okay. You know, loan note that they are talking about here. Are we dealing with an asset or a liability? Let me first ask you that.
Liability.
Are we dealing with an asset or a liability?
Liability.
Do you all agree that it's a liability?
Yes.
Yes.
Okay. Once they say a loan note was issued, the other name for that, it means it's borrowed. You borrowed. That is what they mean. You borrowed money. And that means we are dealing with a liability. You issue a loan note means you borrow. That is the literal way of actually showing the synonyms. It means you borrowed money. So if you borrow money, I've told you today, although there are some liabilities that are measured at fair value through pure health, but at your level, all financial liabilities should be taken as liabilities that are measured at what? Amortized cost. Should be taken as liabilities that are measured at what? Amortized cost. See, this instrument was issued on 1st April 2010, right? 2010. 2010. So if it was issued in 2010, the first year would be March 2011, that is end of year 1. March 2012, that is end of year 2. March 2013, that is the end of year 3. This examiner, he wants us to get what the amortized cost will be as at the end of the second year, which is March 2012. It's asking us how much we are paying the consolidated SFP. That means it's asking for what the amortized cost will be. So I will go ahead and say amount that will be what? Amount that will be what? Amount that we are paying the consolidated SFP. Okay. I hope nobody is raising hand because I'm not seeing any hand up. Amount of the 5% loan note issued that we appear in the statement of financial position as at when? 31 March 2012. Okay, I will borrow something from, in order not to waste time. You know, this trahaj is still here. It's still here. So in order not to reinvent the wheel, let me borrow this thing here. You remember this table. This table. I want to borrow the heading I used there because it's going to be the same. It's going to be the same. That is what we call amortized cost. It's going to be exactly the same. So if you already understand that it's going to be the same, that means you already know what we want to do here. Because I've told you whenever you want to determine amortized cost, is follow the same process. So the first year is the year that ends on 31 March 2011. Yes, because it was issued on 1st April. Then the end of the second year is 2012. 2012. Okay, what is our opening balance? The opening balance is something that is very important. What do you think the opening balance should be based on this financial liability will be subsequently measured as amortized cost? What did you say?
19.5.
19,500.
Yes, equals 20 million. Okay, let me 20 like this because I put thousands of them minus 500, right? That would be 19.5. So you can put a note here, a note that says what? That says, given that the financial liability will be subsequently measured at amortized cost, the initial value should be fair value of what? Of 20 million less transaction cost of what? Of 500,000. So that is what I will do there. So I won't show it. So anytime you want to read this, since you will have the Excel, so if you put your cursor here, it will show it for you. So, let me change the effective interest rate. How much is the effective interest rate on this? It's 10%, is that not? So let me change it to 10%, right?
Yeah.
10%. So I will change this one to 10%. The interest on it is 5%, right?
Yes.
Interest on it will be 10%. So 10. Multiply by what? Oh, okay. It's going to be 10.
No, it's 5%.
Oh, sorry, 5%.
Yeah.
It's 20 million, right? 20
20
million.
million.
I'll say 20 million times 5%, right? 5%. Okay. Then closing balance. So I say initial value, column A, multiplied by what? By 10%. That gives us the finance cost. We now say interest paid, 20 million like this. Then multiply by what? 5%. That gives us 1,000, which is 1%. So opening balance plus this finance cost minus this 1 million, that gives us 2,450. That becomes the opening balance here, right? That becomes the opening balance in the second year. Then you equally now say the opening balance in the second year times what? 10%. 10%. That gives you 2,045. Then here too will still be the same interest of 1 million. It won't change. And you say, I will drag this one here. I will drag this one here. So this is what we are looking for. 21,495. Let's see whether the option is there. Is the option there? Option what?
Yes, option D.
Option D. You know, it becomes a serious matter in the exam if you got something that is not there, it becomes a serious matter. So, but luckily, our option is there. Okay,
I
that is
would
the end
choose
of that.
C.
You will choose C.
If my answer is not in the option, I'll just choose C.
Okay, whenever your answer is not in the option, C is what you choose. So I don't know where you got that from. But you know, if you are choosing C here, you know that C is not correct. You see the magic option is the magic option, right?
To me, it is
Okay.
B. Oh. If I not see my option, I'll choose B.
You will have chosen B.
Yes. Oh.
Yes, even me. I will have chosen B.
Yeah, I'm
because
so
because
campus.
you have because you have B in your option, right? Because you have B, what you have in B is 2450, which is at the end of year one, right?
No, not even because of that.
No,
Oh,
no.
because B appears more often than any other option.
My own
Okay.
calculation I did, it was 2450 I got. So without doing the one for 2012.
Ah, you should rather do for, because if somebody stops in year one, you would think the correct answer is 2450. But the examiner is not asking for year one, which is 2011. It's asking for year two, which is 2012. 2012. Okay, read the last question. Wait, the last question, am I going to do it as well? Because once it is convertible, it's convertible as well. I'm not going to do it. Question 7, I will not do it. I will not do it. You should do it. The correct answer is A. A. So figure out why it is A. Figure out why it is A. So because it's convertible just like that other one. And you know I'm not doing it simply because we've done something like that in that triage question. So that's the end. That is the end. That is the end. So figure out why that one is A. That is the end of our financial instrument. I know I've started it into my colleagues' time now. Do you think we can do IS 10 and IS 8?
I think we need break.
So that would be
Okay, you
great,
need.
though. Oh, sorry.
I thought we just came back around 1 o'clock.
Are we not entitled to our 1 hour break?
Yeah,
We
we
were
need a
Campus.
break.
supposed to go on 1 hour break.
Exactly.
No break today.
Okay, can we look at this? Look at this. Look at this. So to ensure that you're enjoying addition, we can go on 30 minutes break so that side we come in by maybe around 3. So what I want to suggest is maybe we should go on break by 2:30. Then you resume back by 3. Side will come in by 3. Is that agreed?
Yes, sir.
Is that agreed?
Yes, sir. Yes, sir. Yes, sir.
Agreed, though. It's
Yes,
agreed.
sir.
Agreed.
So in 30 minutes, we want to do IS 10 and IS 8 in 30 minutes. And we'll solve the question then. Let's see how easy it is. Please go on mute, Bright. Bright, go on mute. Bright, go on mute. Okay. Lawrence, your hand is up. I've not been seeing hand. I don't know why. Lawrence, has your question been answered?
No, just a quick one. Can you just put a question on that 95? I want to see what you wrote. I want to see what's there.
You get it from the
All right,
exam.
thank you. That's fine. Thank you.
Okay, so I extend this with events after reporting period. IS 10 is defined by events after reporting period are those events, favorable, unfavorable. favorable or unfavorable, which occur between the end of the reporting period and the days the financial statements are authorized for issue. Are we together? Okay. If you understand that correctly, it shows that there are two types of these events. We have adjusting and non-adjusting. Adjusting and what? Non-adjusting. Adjusting events provide further evidence of conditions that exist at the reporting day. They provide further evidence of conditions that exist at the reporting day. While non-adjusting events are indicative of conditions that exist after the end of the reporting period. Adjusting event, we go back and adjust. Adjusting event, we go back and adjust. Non-adjusting event, we don't go back and adjust. We only disclose by way of note. Examples of adjusting events are: one, when a litigation that existed at the end of the reporting period, if before the date of signing the financial statement, authorizing it for issue, if judgment was delivered, and that judgment necessitating going back to the SFP to make provision in the financial statement, then you should go back and make that provision. Another one is if you received information after the end of the year that shows that the asset that exists at the end of the reporting period has impaired, e.g., if a debtor existing at the end of the year was declared bankrupt before the financial statement was authorized for issue after the end of the year, then you should go back and adjust the receivable because the belief of the ISB is that the event that led to the debtor being declared bankrupt did not occur suddenly after the end of the year. It has always been there before the end of the year, but you did not see it. Another one is if an inventory that the cost is 100 at the end of the year was sold shortly after the end of the year, but before the financial statement were authorized for issue, sold for, say, a net realizable value of 90, a net realizable value of 90. But at the end of the year, it was sitting in your inventory at 100. Then, given that you sold it at an NRV of 90, you should go back and adjust that inventory down from 100 to what? 90. The belief of the ISB that issues IFRS is the event that led to that inventory being sold at a net realizable value of 90 shortly after the end of the year. It's not something that occurs after the end of the year. It could be that a competitor has lowered his product and you have no choice than to sell your own at a lower amount. And the event that led to that competitor coming to sell at a lower amount is a technology advancement that has been in existence before the end of the year, but perhaps you were not aware of that. And that was the reason they take it to be an adjusting event. Another example is if a fraud, like we saw today, if you later discover after the end of the year that an amount of cash sitting in your SFP has been stolen, but you only got to know after the end of the year, but it was stolen before the end of the year, you equally need to go back and adjust that cash down because that is an adjusting event. There are many adjusting events that the standard gives us. Examples of non-adjusting events. Examples of non-adjusting events. If a fire, a building or factory was destroyed in fire and the fire occurred after the end of the year, It's a non-adjusting event. It's a non-adjusting event. But if the fact that fire occurred could make that entity to be a going concern, a non-going concern entity, then you should go back and prepare the financial statement using alternative basis. Another example is changing tax rate or tax law after the end of the year. It's a non-adjusting event. Changing tax rate or tax law after the end of the year is a non-adjusting event. What again? Someone else is sharing. I should be the only one. Okay. What else? Lawrence, I'm sure you can. Okay, you've not lowered your hand. Have you lowered your hand? What else are example? Announcement of a plan to discontinue operation after the end of the year. Announcement of a plan to discontinue a particular line of business after the end of the year is a non-adjusting event. So we have several examples of non-adjusting events. Basically, that is all that IAS 10 deals with. It's very short. Can we go ahead and now deal with the question we have there? I will project the question again. I'll project the question again. Okay, so where do I have IS 10? Where do I have IS 10? Okay.
Page 7.
Okay. You want to read? You want to read the question? And choose as usual.
Okay, that's fine. The ones I can choose. Okay, which of the following, which would be treated as a non-adjusting event under IAS 10 events after the reporting period? Which of the following events occurred after the reporting date of 31st March 2015, but before the financial statements were authorized for issue? A. Public announcement in 2015, April of 2015, of a formal plan to discontinue an operation which had been approved by the board in February 2015. B. The settlement of an insurance claim for a loss sustained in December 2014. C. Evidence that $20,000 of goods, which were listed as part of the inventory in the statement of financial position as at 31st March 2015, had been stolen. D. A sale of goods in April 2015, which had been held in inventory at 31st March 2015. The sale was made at a price below its carrying amount at 31st March 2015. I choose C.
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 Okay, do we all agree? Do we all agree?
No, I choose A.
A.
I choose A.
Wait, go on mute.
Oh,
Once you have made your point, go on mute.
yes.
Once you have made your point, go on mute. Okay. Okay. It says each of the following events occur after, okay, which of the following would be treated as a non-adjusting event? A public announcement in April 2015 of a formal plan to discontinue an operation which had been approved by the board in February. Approved by the board, but it wasn't announced until that. So majority of you from what I've heard choose A. Let me look at B. The settlement of an insurance claim for a loss sustained in December 2014. Of course, that is an adjusting event because the loss already occurred before the end of the year. So if settlement took place. That is an adjusting event. C, evidence that 20,000 of goods which were listed as part of the inventory in the statement of financial position as at 31st March 2015 had been stolen. That is an adjusting event. It's an adjusting event. A sale of goods in April 2015, which had been held in inventory at 31st March 2015. The sale was made at a price below its carrying amount as 31st March 2015. That is at a net realizable value that is lower than cost. That one too is an adjusting event, just like I've told you today. The only non-adjusting event here is A. A is the correct answer. A is the correct answer. Now, you know that question, section B of the exam is going to deal with what? Is scenario based. If you look at what I read from the syllabus today, and again, you should get yourself familiar to the structure of the exam on the ACCA website. Section B, they say you will have 3 questions. Put it the other way around, you will have 3 scenarios, but from each scenario, they will build 5 questions. From each scenario, they will build what? 5 questions. So from here, we have a scenario, but it's only 4 questions that we built around it. Question 2, 3, 4, 5. Okay, can you go ahead and read? I love the questions here. I love that. Read it.
While current year end is 31st March 2009, his financial statement was authorized for issue by his directors on 6th May 2009, and the AGM will be held on 3rd June 2009. The following matters have been brought to your attention. First, on 12th April 2009, a fire completely destroyed the company's largest warehouse, and the inventory it contained. The carrying amounts of the warehouse and the inventory were $10 million and $6 million, respectively. It appears that the company has not updated the value of its insurance cover and only expects to be able to recover a maximum of $9 million from its insurers. 2. A single class of inventory held at another warehouse was valued at its cost of $460,000 at 31st March 2009. In April 2009, 70% of this inventory was sold for $280,000, on which Waxworks sales staff earned the commission of 15% of the selling price. 3. On 18th May 2009, the government announced tax changes, which have the effect of increasing Waxworks' deferred tax liability by $650,000 as at 31st March 2009. Question 2. At what amount will the warehouse and inventory of Waxworks be included in the statement of financial position as at 31st March 2009? A. $10 million and $6 million, respectively. B. $10 million and $6 million, respectively, less any proportional adjustment to cater for the loss due to underinsurance of the assets. C. No value should be included in the financial statements as the assets have been destroyed by fire. D. At $9 million allocated proportionately between warehouse and inventory.
What do you guys think?
A.
The amount
I go with
You know, that question 2 relates to Roman figure 1 part, right? Okay, so you say on 12th April. So the year end of the company is 31st March 2009, right? The AGM date was 3 June 2009, right? Annual general meeting. And the financial statements were authorized for issue by its director on 6 May, right? 6 May. So you have 31st March 2009 as the year end. It now says on 12th April 2009, a fire completely destroyed the company's largest warehouse. And the inventory it contained, the carrying amount of the warehouse and the inventory were $10 million and $6 million, respectively. It appears that the company has not updated value of insurance cover and only expect to be able to recover a maximum of 9 million. You guys said it's A. Do we all agree that it's A?
No, C.
C. Fumi says C because C says no value should be included in the financial statement as the assets have been destroyed by fire. Oh, Fumi, I thought when I was giving the example of non-adjusting events, I said when the fire affects your plan, your assets, and you have the evidence that the fire did not start before the end of the year. The fire started after the end of the year. It's a non-adjusting event. You know, I mentioned that today. I gave you that example. Please, for those in Ivy League, if you check your handout, you have the full picture, the full list of adjusting and non-adjusting there. Copy directly from the standards, copy directly from IS10. The full list of adjusting, the full list of non-adjusting, they are all there in the handout. So, and beside, I've mentioned that today. The correct answer is A. The correct answer is A. The correct answer is what? A. It's a
So if the loss of
non-adjusting.
warehouse,
Okay, continue. Question 3, continue.
okay. Now,
Sorry,
if the loss of
before you
warehouse and
continue.
inventory, in fact,
Sorry, before you continue, I'm seeing a hand up. Right, is that Esther? Yes.
Yes, Esther, sir.
Uh,
Sir, please,
go ahead.
not A. Can you A?
Can I do what?
Explain why it is A. It's not clear to me.
It's a non-adjusting event. It occurred, the event occurred, the fire occurred after the end of the year. Despite the fact that it has destroyed your inventory, it occurred after the end of the year. You don't go back and adjust. When I was doing a quick revision of IS10 now, I mentioned specifically that a fire that occurred after the end of the year, if it destroyed your asset, it's a non-adjusting event. Non-adjusting event means, despite the fact that as at the day you were approving the financial statement, those assets are no longer there. But were they there as at the end of the year, 31 March 2009? The answer is yes. Fire only destroyed them after the end of the year. So you will not adjust the financial statement. The inventory and the warehouse will still be there. You will only disclose by way of notes that those assets are no longer there. The assets that users are seeing in the FFP are no longer there. You will only explain that by way of notes. But looking at your financial statement, no, you will not go back and adjust. I hope that is clear.
Very clear, sir. It's okay. Thank you.
You're welcome. Please continue reading. Sorry, continue reading. You can lower your hand.
if the loss of the warehouse and inventory in fire had significantly affected the ability of housework to continue as a going concern, how should the company reflect the warehouse and inventory in its financial statements? A, at $10 million and $6 million respectively. B, at $10 million and $6 million respectively, less any proportional adjustments to cater for the loss due to underinsurance of the assets. C, at $9 million allocated proportionately between warehouse and inventory. D, the financial statement should be prepared using alternative basis. I choose D, as stated earlier.
Yeah, this is the answer. If you just break up.
As hinted earlier, so you heard that clearly. Okay. As hinted earlier, the correct answer is D. As hinted earlier, if the fact that fire has destroyed the asset of this company, it will prevent this company to operate as a going concern. Then, despite the fact that the fire occurred after the end of the year, despite the fact that the fire occurred after the end of the year, the financial statement should be prepared using alternative basis. I heard somebody mention breakup basis. No. In fact, if I put another option here and call it breakup basis, if you choose that option, you'll be wrong. You know why? If there is an option here called breakup, the financial statement should be prepared using breakup basis. And we have this option D here. Option D will be the correct one. That breakup basis will be the wrong one. You know why? Because there is nowhere it is mentioned in IFRS. Breakup basis. Breakup basis is not mentioned. What the standard says is alternative basis. So in real life, you have to figure what that alternative basis is. It is under US GAAP that they will say liquidation basis or breakup basis. But under IFRS, it's a principle-based standard. What they say is alternative basis. So can you read question 4?
Question 4. What value should the inventory in 2 be carried in the financial statement?
Okay. In 2, let's do. If there were time, I would have asked you guys to individually do this question 4. I would have loved to ask you guys to do this question 4 if time were to be permitted. What do you guys think? At what value should the inventory be carried?
Should be carried at realizable start lower than that guy.
400,000.
Calculate it.
400. Wait, we have how many options there? We have 460, which is option 1. We have 280, which is option 2. We have 340, which is option C. And we have 400, which is option 4. Option D. You said 400. Do we all agree?
C.
Do we all agree?
I think it's C.
I don't know what it is. So, okay, let me share the Excel. Please take care of you have the question with you. Let me share the Excel. Let me quickly share the Excel. Rename IS10. Okay, sorry. Remember what we selected MCQ on IS10. What did we select as our solution to question 1? Can you remember?
Number 1.
A,
Number 1 was yes.
A, right?
Number 2 is yes. Number 2 is
Number
A2.
2 is number 2A. Okay.
Yes. Then
Number
number 3 D.
D, right?
D. Yes, D.
Number 4 now that we want to do, right? Number 4 we want to do now. So let me just delete every other thing here. Okay, number 4. So what we want to do is, at what value should the inventory in 2 above be carried in the financial statement? The value at which inventory in 2 will be carried in the financial statement, right? Right. Okay, so let's go ahead and do the working. You guys have said, in this scenario, if you look at that scenario where it says a single class of inventory is just one inventory held at another warehouse value at its cost of 460 at the first month. In April, 70% of the inventory was sold for 280 in April, on which work sales staff earned a commission of what? 15% of the selling price. Okay. So 70%. So 70%, I would say 70% sold after year end, right? Year end. So let's calculate or derive NRV on that one that was sold after the year end. Let's determine the NRV of that one. So sales price. It was sold for how much? How much was it sold for? The 70% that was sold. 280, right?
280.
You know, net realizable value is estimated selling price, less estimated to complete, if any, and less estimated selling price. So I would say selling price, right? Selling price is, remember the sale occur after year end, though. So it's not that it has affected the inventory before the year end. Selling price, so selling price, selling cost, or cost to sell. Cost to sell. That is 280 times 15%, right? So I take this figure times 15%, right? I want to put it in jacket. Okay, so that means the NRV on the 70% that was sold, NRV on 70% sold is 238. So if you want to now derive NRV on the entire inventory, what will you do? You will say 238 being the NRV of 70%. You will not gross it up. You divide it by 0.7. Are we together? You divide it by 0.7, which is the 70%. You say divided by 0.7, 340. So on the entire inventory. So when you now compare it with, compared with the cost of 460, right? The NRV of 340 of what? 340 is lower, right? And as such, the inventory should be carried in the SFP at 340. IS2 is that, right? 340 according to what? IS2. So the correct answer here is what? Is, where is 340 among the options? Where is 340?
Option 6.
Option.
C.
Did anybody get that? Did anybody get that? No.
Yeah.
Yeah,
Is that what you got?
Lady.
Yeah.
Yeah, Fumi got it.
So when compared with the cost of 460, the NRV of 340 is lower. And as so, the inventory should be carried in the SFP at 340 according to IS2. Yes. Okay, question 5. You still have the question with you, right? Question 5.
How should WASWORK account for the announced tax changes by government? A, at $650,000. B, not an event after reporting. This is not an event after reporting, and as such, it should be ignored. This is non-adjusting event. Those way of notes. Adjust the creditors liability at 31st 2009 upward by 650,000 and adjust current tax accordingly. I choose C.
D.
See, I just see. Even when it's
C.
not adjusted, self.
Okay.
C. C.
You read question 5, right? You read question
B.
5. How
D.
should
I think it should be
mass
B.
work account? How should mass work account for the announced tax changes by government? Okay, I'm sure that is in Roman figure 3, right? They say on 18 May 2009, the government announced tax changes which have the effect of increasing mass works deferred tax liability by 650 as at 31st March 2009. Okay. Okay. So you said you choose which option, please? I want to hear that again.
D.
Option C. C.
I think it's B.
C.
C. Even if non-adjusted, self
C.
disclose it.
Option C.
It's
Wait.
C.
I hear C. This is a non-adjusting event and should be disclosed by way of no. That is C. Option D says adjust deferred tax liability at 31st March 2009 upward by 650 and adjust current tax accordingly. Okay. Nobody choose option A, right? And nobody choose option B.
No, B.
I choose B.
I
I
chose
go
B.
with B.
Same here.
The correct answer is B. B for ball. B for ball. Are you surprised? Is B? This is not an event after reporting period, and as such should be ignored. You know why? It is B.
No.
Okay, go. Come back. It will have been a non-adjusting event if not for when did that event occur? According to this note 3, it occurred on 18 May, right?
Yes.
18 2019. Fantastic. When were the financial statement authorized for issue? When?
6th May.
Adjusting event after reporting period are those events that occur between the end of the reporting period, which is 31st March 2009, and the date the financial statement were authorized for issue. Financial statement were authorized for issue when? 6 May. Is it not 6 May?
Yes.
Any event that occur after
Oh,
that
no.
period is not an event after reporting period. You guys didn't pay attention to this. That is the
Oh,
trick.
sorry. It's the date.
Okay.
It's the date
Anything
part.
that occur after the day the financial statement was authorized for issue should be ignored. It should be ignored. That is the main thing there. So the correct answer there is what? Is B. Is B.
Mr. Jami, sorry. If it was between that date, that means the correct answer will be C, right?
The correct answer, see, this a non-adjusting event. Yes.
Okay. So is that date?
Yeah. So is the date. So the correct answer is B. Okay. Unfortunately, it's past 2:30 in Nigeria. It's 2:35. You know what I want to do? Just for you to take note. Unfortunately, it shows that we can't do IS8. We cannot do IS8. We cannot do IS8. So when I'm sending the exec to you, I will just put the solution to IS8 there. I'm sure you can revise IS8 on your own. I have 5 questions there. I will just put the solution there in the Excel. That is the end, so that you guys can go for 30 minutes before Said will come back. Said will meet you by around 3, around 5 minutes past 3. Thank you very much. So I will send you the solution to IS8 as part of the Excel that will be sent to you. Thank you very much. Thank you very much.
Can you please maybe explain that for 5 minutes in terms of the errors in accounting estimates, just a summary of the standard?
Sorry, I can't hear that.
Can you please assist us like in explaining, even if it can take you like for 5 minutes to explain like the changes in accounting estimates and the errors, just like for 5 minutes, the summary of it, like how you were doing with other questions, and then we can do the questions by ourselves.
Okay, I will quickly do that because you requested for it. Okay, so
thank you very much.
ISA deals with 3 things. Number 1, it deals with accounting policy. Number 2, it deals with errors. And number 3, it deals with accounting estimates. Now, under accounting policy has a definition. It has a definition. And the definition of accounting policy is those basis, rules, conventions, practices that governs how financial statements are prepared and presented. Those are accounting policies. Rules, conventions, practices, principles, and that governs the preparation and presentation of financial statements. Those are accounting policies. Now, beyond that, the question is, how do you select accounting policies? Accounting policies should be selected based on the accounting standard. If you want to determine which accounting, if you have just bought a motor vehicle and you want to use it, that is a property, plant, and equipment. So you go to IAS 16 to select the accounting policy. If you have got government grants and you want to know how to account for it, you turn to IAS 20 to know how to account for it, right? That is what we mean by select accounting policy based on the relevant accounting standard. Are we together? However, what if there is no accounting standard dealing specifically with that item? If there is no accounting standard that deals specifically with that item, what do you do? What you do is, number one, the standard says select a standard that deals with similar item. A standard that deals with similar item. What do we mean? What do we mean? If you get a grant from government, say government of Kenya, of course, you will use IAS 20. But if you get a grant from the richest man in Africa, Dangote, Dangote is not a government. It will not meet the definition of government. If you want to know how to account for that, you turn to a standard that deals with similar item, in which case you will turn to IAS 20, and you will still account for that grant that you receive from Dangote as if it is what? As if it is government grant. That is number 2. What if there is no standard that deals with similar items? There is no similar item that has been dealt with in under another standard. What do you turn to? What I'm telling you now is hierarchy of selecting accounting policy according to IAS 8. What do you think you need to do? Management should use their judgment to select appropriate accounting policy by considering the following in the order listed. Number 1, you turn to the conceptual framework. The 2018 ISB conceptual framework, it defines asset, it defines liability, it defines income, it defines liability, it defines expenses, and it defines equity. So every item in the financial statement will fall in those 5 categories: asset, liability, income, expenses, and equity. Whatever you want to account for will fall under any of those 5. So the first thing you should turn to, in the absence of any accounting standard dealing specifically with that item or similar item, is turn to the conceptual framework. The conceptual framework will help you. What if the conceptual framework cannot help you to select accounting policy? What next? What next? What do you think? the next thing is look for another pronouncement by another similar standard setting body. An pronouncement of another standard setting body that uses conceptual framework similar to that of the IASB. So you can turn to US GAAP, or you can turn to maybe Australian GAAP, or you can turn to Singapore GAAP, since they use conceptual framework similar to that of IASB. What if there is no other similar standard setter that has made a pronouncement? What else do you think you should use? They say you should use your judgment to select accounting policy by looking at what? The accounting literatures and industry practice. Accounting literature and what? Industry practice. That is when it comes to selection of what? Accounting policy. The next thing under accounting policy is change in accounting policy. Can you just change accounting policy? No. Whatever accounting policy you have selected, you should use it consistently. But there are two circumstances under which you can change. Number one, if there is a new pronouncement, a new standard, or a new interpretation that has just been released by the IASB and is forcing you to change your accounting policy, that is the first instance or condition under which you can change. Number two, if you are changing voluntarily because you are considering the new policy to lead to a better presentation of information, a more relevant and reliable way of presenting the information. If that is what you are doing, then you can change voluntarily. Are we together? So that is about the circumstances under which you can change. The next thing is, how do we change accounting policy? How? I'm sure the next thing you guys will say is what? Let me put the question across to you. How do you change accounting policy? How? I'm sure you guys can hear me, right? Confirm that you can hear me. Or...
Yes, we
I
can.
think it's
We
Richard's
can hear
mic.
you.
We can hear you.
Okay. So how do you change the accounting policy?
I think it's retrospective.
Prospectively.
Oh.
Retro, I
Wait,
don't know.
wait.
Retro.
Retro.
Listen and listen good. This is how you change accounting policy. Number one, if you are being forced to change because a new pronouncement has arrived from the IASB or a new interpretation of the interpretation committee has arrived and is making you to change your accounting policy, follow the transitional provision of that new pronouncement. The new pronouncement is the new accounting standard or interpretation. It will have transitional provision. So follow the transitional provision of the new pronouncement. What do we mean by the transitional provision? Every new pronouncement by way of new accounting standard or amendment or interpretation, we contain transitional provision. And what transitional provision is focusing on in how do you make the change? So that new pronouncement will tell you how you should make the change. However, if you are changing voluntarily, because you believe the change will result in reliable and more relevant presentation of information, then you should change retrospectively. You should change what? Retrospectively. Unless it becomes impracticable to do so, you should change retrospectively. What does it mean to change retrospectively? You change the new policy and apply it to all the prior years as if the new policy had always been applied. You should change the new policy and apply it to all the prior years as if the new policy had always been applied. That is what we mean. But if it becomes impracticable, then you may not be able to go back retrospectively. Then you can change from the earliest date that it becomes practicable for you to change. That is what IS 8 says. That is about accounting policy. The second thing IS 8 deals with is error, prior year error. We saw it in the question we did today. You remember in that question of triage, we saw that 400 million of 700 of receivable have been stolen. We now analyze that 450 relates to prior year. 450 relates to prior year. And you know that 450, we did not charge it to the P&L of the current year. We took it to what? Prior year. So prior year error should be corrected using what we call retrospective restatement. Retrospective restatement is like retrospectively similar to changing policy as well. That means the prior year error will be corrected as if the error never occurred. That means the error that relates to prior year should go and hit prior year P&L. In the question we did today, we did not put prior year there. That 450, you saw that I took it to retain earning. Had it been we are asked to show the prior year statement of P&L, I will take that 450 to the P&L of prior year, provided it occurred in that prior year. That is what we mean by correcting prior year error using retrospective restatement. The third one is accounting estimate. That is the simplest one to deal with. Accounting estimates such as provision. When we do provision, it's an accounting estimate. When we do depreciation, it's an accounting estimate. Depreciation method, when you are changing from straight line to reducing balance, it's an estimate. When you are changing from, when you change the residual value, it's an estimate change. When you change the useful life, it's an estimate change. And when provision amount changes, it's a change in estimate. Change in estimate should be applied prospectively, which means you don't tamper with the prior year. You only continue from going forward. You don't tamper with the prior year. That is why when you change the depreciation rate or you change the residual value, you don't go back to last year depreciation. You apply it prospectively, which is from the future year. That is how we deal with changing estimate. Lastly, I'll have a question for you. If you are using cost model for PPE, property, plant, and equipment, assuming prior year was 2020, you use cost model. In 2021, you are changing. Let's say it's a building. You are changing from cost model to revaluation model. Did you get me? In 2020, prior year, you use cost model for building as a class. In 2021, you want to use revaluation model. So you are changing from cost model to revaluation model voluntarily, because we believe that that new model will lead to reliable and relevant presentation of information. My question is, how do you apply that change? Do you apply the change retrospectively, in which case 2020, when you never revalue before, you have to revalue for 2020? Or will you apply the change prospectively, in which case you will forget about, you will say to 2020, bygone is bygone. You only revalue in 2021. What would be your answer? That would be my last statement.
I think prospectively. Going forward.
Retrospectively.
What did I hear?
Prospectively.
Okay, I'm hearing the two. I'm hearing prospectively, I'm hearing retrospectively. Esther, you raise your hand. You want to tell us?
It's accounting policy now, so it should be retrogressively.
Yes. Go on mute, Emmanuel. Esther, speak. Esther, speak. You raise your hand.
Hello, sir. Yes, I wanted to say retrospectively since we were changing policy. I said
Okay, you think it
retrospectively
should
because
be
it was a
change-
change in policy.
Yes.
Can you hear me?
You are all right. I hear you. I hear you. You can go back on it. Thank you. I hear all of you. It's a change in policy. It's a change in policy. Changing from cost model to revaluation model is a change in policy. But listen to this. Listen to this. Listen to this. Because this thing can be examined, listen to it. IAS 8 specifically says, IAS 8 specifically says, changing from cost model to evaluation model under IAS 16 PP and under IAS 38 intangible asset is outside the scope of IAS 8. Did you hear that? Change from cost model to revaluation model under IAS 16 and under IAS 38 is not a change in accounting policy to be dealt with under IAS 8. IAS 8 does not apply. You know the implication of that? You will not change that policy retrospectively. You will not go back to 2020 to go and revalue. You will only start the revaluation from 2021. Is that clear? You will only start from 2021. That only applies when you are changing from cost model to revaluation model under IAS 16, property, plant, and equipment, and under IAS 38, intangible assets. It does not apply. This exception does not apply to investment property under IAS 40. You know why it does not apply to investment property under IAS 40? If this were to be investment property, if you are changing from cost model to fair value model, IAS 8 applies. You must apply that retrospectively. You know, the reason is that because when you were using IAS 40, when you were using cost model, or when you use cost model for investment property in 2020, IAS 40 will have asked you to disclose the fair value. That means the fair value was available in 2020. So if you change your mind in 2021 to move to fair value, for investment property, you have to go back retrospectively. But when it comes to PPE under IAS 16, intangible assets under IAS 38, you are changing from cost to revaluation model. You should not go back retrospectively. You should not go back retrospectively. I think that answered that question. Thank you very much. Thank you very much. So the break will still be like 30 minutes. So this is 2:54. So I will call me maybe about 3. Thank you. Enjoy your day.
Thank you very much. It was very helpful.
Thank you, sir.
Thank
We
you.
appreciate it.
Thank you, sir.
Thank you.
Thank
I
you,
hope
sir.
to see all of you.
Thank you,
I
sir.
hope to see all of you in SBR class next diet. SBR. That is where I will be waiting.
Amen. Thank you so much. We're grateful.
Definitely registering.
Thank you, sir.
Ah.
Thank